You open your mailbox and find a tax form for a debt you settled years ago. The bank says you owe taxes on $5,000 you never even saw. It feels like you're being punished for finally getting your head above water. Today, we are breaking down the IRS rule that can actually wipe that tax bill away.
It is called the Insolvency Rule, and it is a complete game changer for anyone dealing with a 1099-C. Most people panic and just pay the tax, but the IRS actually has a specific path for you to pay zero if your debts were higher than what you owned.
Check your mail. Did you get a 1099-C from a credit card or car loan? Comments mail if you did. I'm trying to see which banks are sending the most this year.
So let's start with the basics. A 1099-C is a cancellation of debt form. When a bank forgives more than $600 they reported to the IRS as income.
That is what confuses people. They feel like they didn't get any cash, so why is it income? I saw a comment on Reddit where someone said they got a 1099-C for a loan charged off back in 2013, and they were absolutely blindsided.
Exactly. The IRS view is that if you no longer have to pay back $10,000, your net worth just went up by $10,000. It's phantom income. But here is the debunk. You aren't automatically stuck with the bill. If you were insolvent the moment before that debt was canceled, you can exclude it.
Insolvent sounds like a fancy legal term. What does it actually mean for a regular person?
It's simpler than it sounds. According to IRS publication 4681, you are insolvent if your total liabilities, meaning everything you owe, are more than the fair market value of all your assets. Assets include your car, the cash in your bank, and even your clothes and furniture.
So if I owe $50,000 in student loans and credit cards, but my car and stuff are only worth $10,000, I'm insolvent?
Precisely. And the rule says you only pay tax on the portion that actually made you solvent again. If you were underwater by $20,000 and the bank canceled $10,000, you still owe more than you own. In that case, the whole $5,000 is tax-free.
Let's do a quick poll. If you added up every debt you have right now versus everything you own, car, cash, clothes, would your debt be higher? A, yes, way higher. B, about even. Or C, I'm actually doing okay. Comment your letter below.
Let's look at a real example. Imagine a single mom with a $10,000 credit card settlement. Her total debts, including that card, were $15,000, but her assets, an old car, $500 in cash, and her furniture were only worth $8,000.
Okay, so let's do the math. 15,000 in debt minus 8,000 in assets means she's underwater by $7,000.
Correct. That $7,000 is her insolvency amount. Now, the bank canceled $10,000. You subtract the $7,000 insolvency from that $10,000 canceled debt. That leaves only $3,000 that the IRS considers taxable income.
So instead of a tax bill on 10,000, she only pays on 3? That is a massive difference.
It's huge. At a 15% tax rate, she just saved over $1,000. You report this on Form 982. You check box 1B and put the amount on line 2. You attach it to your 1040 and that's it.
Is there anything this doesn't cover? I know people get confused about contractor income.
That is a major trap. You cannot use insolvency to wipe out 1099 NEC contractor earnings. This only applies to canceled debt. Also, if a parent forgives a loan as a gift, that's usually not 1099-C income anyway. The biggest mistake is thinking, I'm broke, so I don't need to file. If you don't file Form 982, the IRS computer will flag you for missing income automatically.
So, what is the first move for someone holding one of these forms right now?
Step 1. Go to irs.gov and search for publication 4681. Flip to page 6 and find the insolvency worksheet. Step 2. List every debt you had the day before the cancellation. Step 3. List what your stuff was worth that same day. If the debt is higher, fill out Form 982.
If you know someone who settled a credit card for pennies on the dollar last year, send them this. They're about to get hit with a tax bill they don't actually have to pay.
And remember, I'm an educator, not your CPA or tax advisor. This is general information based on IRS publications, not personalized advice. Tax situations vary. Always consult a qualified tax professional about your specific circumstances before making decisions.